Well, good morning, Joginder Rana here. And the topic of the day is basic principles of general insurance. Basic principles of general insurance. So when the insurance pays or when the insured pays the premium and the insurer accepts the risk, the contract of insurance is concluded. I repeat, when the insured pays the premium and the insurer accepts the risk, the contract of insurance is concluded. So the policy issued by the insurer is the evidence of the contract. Now, like any other contract, the contract of insurance is completed when one party accepts the offer made by the other party. The offer usually comes from the proposer and the offer is known as the proposal. So, insurers indicate acceptance by the issue of a cover note or a policy. Now, no contract is valid unless there is a due consideration. So, in the case of insurance contracts, premium is the consideration from the insured and the promise to indemnify is the consideration from the insurer. So, both parties should be of the same mind with a common intention. For example, if the proposer desired fire insurance and the insurance issues a burglary policy, there is no consent arising out of the common intention. So the persons to the contract should be competent to contract. Minors and persons of unsound mind cannot enter into insurance contract. So the object of the contract must be legal and not against public policy. For example, stolen goods cannot be insured. The insurance contracts are subject to certain special principles evolved under common law in the UK, which are generally followed by Indian courts. These principles are known as fundamental or basic principles of law of insurance. The first one is utmost good faith. The practice to a commercial contract according to the law are required to observe good faith. The seller cannot mislead the buyer in respect of the transaction, but he has no obligation to disclose all information about the subject of the contract. It is the buyer's duty to be careful whilst entering into the contract. Let the buyer beware is the legal rule. So an insurance contract also good faith is required to be observed, but in a more onerous way. The proposer has a legal duty to disclose all material information about the subject matter of insurance to the insurer who do not have this information. So material information is that information which enables the insurers to make the underwriting decision. That is the decision whether to accept the risk and the rate of premium and terms and conditions of the acceptance. So this is called the legal duty of utmost good faith arising under the common law. The duty applies not only to the material facts but to the which the proposer knows, but also extends to material facts which he ought to know. Because the contractual duty is there. Proposal forms are designed to obtain all material information about the subject matter of insurance. Each form contains a declaration to the effect that all the questions have been answered truly and correctly. and that the proposals and declarations shall be the basis of the contract. So the legal effect of the declaration is that insurers can avoid the contract if the answer is inaccurate. Inaccurate means incorrect. Even if the answer is not material to the risk, this is called the contractual duty of utmost good faith, which is far stricter than the common law duty. So the duty of disclosure of material information regarding a proposal or policy also applies to the insurers, agents or insurance intermediaries as provided in the IRDA regulations. Then comes the insurable interest. The owner of property has a right under the law to effect insurance on the property if he is likely to suffer financially when the property is lost or damaged. So this legal right to insure is called insurable interest. Without insurable interest, the contract of insurance will be void. Because of this legal requirement of the insurable interest, insurance contracts are not gambling transactions. Ownership of property and joint ownership is a clear example of insurable interest. A bank has insurable interest in the property on the mortgage of which loans have been given. So the interest is limited to the amount of loan. Usually under such circumstances, the policies are issued in the joint names of the insured and the bank. A ship owner has insurable interest in the ship owned by him. Cargo owners, both sellers and buyers, have insurable interest in the goods owned by them. So, time when the insurable interest is required in fire and miscellaneous insurance policies, insurable interest must be present both at the time of taking the policy and at the time of loss. For example, if the property insured under a fire insurance policy is sold and there is a loss under the sale, after the sale, the insured cannot recover the loss as he has no insurable interest at the time of loss. In marine cargo insurance, insurable interest is required at the time of loss. It may not be present at the time of effecting insurance. An importer of goods may insure the goods under the marine policy, although at that time he may not be the owner of the goods. The ownership of the goods passes from the exporter to the importer when the payment is made. If goods arrive damaged at destination and if the importer had paid for the goods, he can recover the loss as he has insurable interest at the time of loss and also has a policy. So in marine hull insurance, insurable interest must be present at the time of taking the policy and at the time of loss. There is also assignment. Assignment means transfer of rights and liabilities of an insured to another person who has the acquired insurable interest in the property insured. So generally, fire and miscellaneous insurance policies are assigned only with the consent of the insurer. Marine cargo policies are, however, freely assignable without the previous knowledge of the consent of the insurer. So the reason is that the ownership of goods insured under a marine cargo policy frequently changes when the goods are still in transit, and it is not necessary that the benefit of the policy should pass to the new owners. So marine hull policy cannot be assigned without the consent of the insurer. Then comes the indemnity. The object of the principle of indemnity is to place the insured after a loss in the same financial position as far as possible as he occupied immediately before the loss. So the effect of this principle is to prevent the insured from making a profit out of his loss. So the measure of indemnity applied to some types of property is explained below. Say in building. In these cases, the cost of restating the building or repairing the damaged portion is assessed, and from that an appropriate allowance is made towards depreciation depending upon the age and condition of the building. In machineries, the measure of indemnity is the replacement value at the place and date of loss or damage, less an appropriate allowance toward depreciation. But in case of stocks, and that's particularly stocks of wholesalers and retailers, the measure of indemnity is not the selling price or the wholesaler or the retailer, but it is the price at which he can replace the goods. So the element of expected profit does not play any part in computing the measure of indemnity. So fire insurance policies may be issued on the statement value basis. Under these policies, generally issued for covering building or machinery. The basis of indemnity is the cost of restatement or replacement value. So this principle also has its corollary, that is called subrogation. Now, subrogation may be defined as the transfer of rights and remedies of the insured to the insurer who has indemnified in respect of the loss. So, the insured has any rights of action to recover the loss from any third party who is primarily responsible for the loss. The insurer, having paid the loss, is entitled to avail himself of these rights to recover the loss from the third party. So the effect is that the insured does not receive more than the actual amount of his loss, and any recovery affected from the third party goes to the benefit of the insurer to reduce the amount of his loss. So the principle of subrogation arises from the principle of indemnity. The principle may be illustrated by an example. Say, for example, if a cargo is damaged due to the negligence of the carrier. For example, railways, truck operators, shipping companies, etc. Now, who have an obligation to make good the loss of the insured? The benefit of this obligation is passes to the insurer. And then there is contribution. An insured may have several insurances on the same subject matter. If he recovers his loss under all these insurances, he will obviously make a profit out of his loss. So common law has therefore evolved the principle of contribution, which may be defined as the right of insurers who have paid a loss under a policy to recover a proportional amount from other insurers who are liable for the same loss. So the principle of contribution would lead to a situation in which the insured would be able to recover his loss from any one insurer, who then will have to effect proportionate recoveries from other insurers concerned. So in order to avoid this, fire policies and a majority of accident policies contain a contribution condition which modifies the common law policy position. And the last one is proximate cause. So the object of insurance is to provide indemnity for such losses as are caused by the insured peril. If stocks are burnt, then the cause of loss is fire, which is covered under a fire policy, and hence the claim is payable. If stocks are stolen, the loss is not payable under the fire policy, as burglary is not a peril covered. If stocks are burnt by a bomb dropped by an enemy country, then the loss is caused by war, which is an excluded peril and hence not payable under the standard fire policy. Thus, it is important to determine the cause of loss to decide whether the loss is payable or not. So, there is no liability for a loss caused by an uninsured peril or an excluded peril. If the loss is brought about only by one event, it would be no problem to decide the question of liability. But in actual situation, the loss may be the result of two or more causes acting simultaneously or one after the other. Then it becomes necessary to choose the most important, the most effective, the most powerful cause which has brought about the loss. So this cause is termed the proximate cause, all other causes being considered as remote. All other causes treated as remote. Say, for example, there is an example based on the English law. A person insured under a personal accident policy went out hunting and met with an accident. So due to shock and weaknesses, he was unable to walk. So whilst lying on the wet ground, he contracted cold which developed into pneumonia which caused his death. So the court held that the proximate cause of death was the original accident and pneumonia, a disease which is not covered under the policy. Only a remote cause, hence the claim was payable. So an insured suffered accident injuries and was taken to hospital. While undergoing treatment, he contracted an infectious disease which caused his death. So in this case, the court gave a contrary ruling. The proximate cause of death was the disease and the original accident only a remote cause. Hence, the claim was not payable under a personal accident policy. So all these four basic principles, that is utmost good faith, insurable interest, indemnity, and both the corollaries of insurance, principle of indemnity, that are contribution and subrogation. And the last one is proximate cause. So these are the basic principles which are applicable to all the general insurance contracts. The object of the contract must be legal and not against the public policy. So inclusion of all these basic principles is must in all these general insurance contracts. Thank you very much.